morning, everyone. My name is Anae Agostini. I'm CEO of CID Insurance Programs, and I want to welcome you to our workers' comp webinar, How to Better Understand and Manage Workers' Comp. I will be your instructor today. Lexi Goldspring, our work comp underwriter, who's wonderful, unfortunately had a death in the family, so she and it just happened, so she's not going to be able to join us today. But I think you'll be. I think I can manage it, and everyone will because I've got years of experience. And then also, I want to introduce Jacob Cole, who's our marketing specialist, and he works behind the scenes to make sure everything goes smoothly. So let's get started. Well, we've got, everyone's probably listened to these logistics before, but everyone's muted. You're able to hear, but you won't be able to speak. However, your voice is important to me. I want, please put your questions into the chat room at any time throughout the webinar. I'll stop and answer your questions as we go. Okay, and then we've got a survey at the end that we really would like your feedback. So take a moment to take that survey. Now, what are our objectives for today? Well, simply just the same as the title. We want to better understand and manage workers' comp insurance. A lot of insurance brokers will write, property casualty, but they don't step into the workers' comp, and it's really important to take some time to understand it better. And then let's dig deeper into claims history, how to handle a risk with loss history, and then what's that darn X-bond system that your insured participate in, and then learn how to effectively obtain new business workers' comp quotes, and then understand our appetite. So I'm gonna delve into all of this. So let's get started. Well, let's start with some basics. So some of you, I don't know exactly what states all of you that are participating are representing. So that will play a part in this discussion, because workers' comp in general, it's really designed to cover businesses for their statutory and legal obligations for any kind for covered employee expenses as a direct result of on-the-job injuries and illnesses. And one of the question marks there is when you call disease or illnesses is COVID-19 part of that. I have not seen anything surface yet. However, that's not to say that it may have or will. So that will be something that will come forward at a later date. Now, also, we're talking, I mentioned states, so it will vary state to state depending on what type of state plans, benefit plans that they have in place. If you a monopolistic state like Washington State, there's no criteria for an employer to have to purchase a workers' comp. If you a state like Texas, you've really got the option to do it or not do it. And then states like we're in California. California, if you have employees, you have to purchase workers' comp. So that will vary. And then this type of coverage, really how they develop the business classification codes rates through the actuarial calculations, and that's and then it's going to be debited or credited by the defined state territories, because all of the carriers have gone to breaking things down by territories within the state, because some are going to be more hazardous or prone to claims than other parts. So just giving you a basic background on it, and we can now step right into talking about new business quotes. And what is the success formula? If you really look at it, what do we consider a complete submission? Typically, when we receive submissions, there's the hardest part is there's usually a repetitive error that we see or missing information on our submissions, which wastes both your time and our time when it comes down to trying to get a quote out to you, a competitive quote your way. So the detailed description of the business operations is probably one of the big ones. So that, and what does that mean? You need to be asking questions of what the business does, and because you've got to be able to determine whether their current classification codes are accurate. Have they, and so thus you've got to have a detailed description. Sometimes people don't tell you everything that they're doing, or you may, as a broker, make those assumptions. And the important thing is to always ask enough to find out what they're doing. Check their website out. That will tell you a lot. And then one of the other things that's definitely forgotten most of the time is the FEIN number. We cannot quote without that number. They've really locked us down tight unless we have that number in order to be able to provide competitive quotes for you. So please, that's always going to be first on the list of things that you need to get from the insured. And then what is considered payroll? Obviously, if a company has employees, that's going to be considered payroll. But what about 1099s? That's a whole new area that's opening up. And in California, they passed a new law. I think it's SB5, AB5. I can't remember exactly. That really is driving, independent contractors to become more like employees. And so it's getting even harder in California. I don't know about other states, but it's important to understand that if a 1099 independent contractor that's providing services to your insured, if they cannot show that they have a business license, professional license, business insurance, and to include work comp, proving they are a separate entity, they will potentially be deemed an employee of the insured, and the amount paid to them would be reported as payroll in an audit. So make sure you're having this conversation with your insured about independent contractors or any 1099s, because no one wants to have that incurred additional premium due, and the surprise that comes with it, your insured being upset, and that's one of the fast ways to have your insured get upset. Also, best practice for classifying job duties. That's why you need a detailed description of the business operation. Sometimes you can help them by actually placing certain employees in a lower classification if they qualify for it. But that is an important area to be looking at to see whether the employees are classified properly. And then when do we need loss history? We don't necessarily on smaller accounts. If you tell us there's no prior, right? Like there's no losses, we can quote subject to, and then if you bind the coverage, we just need to get that loss history. So that's one way of addressing, but this is really the success formula, and hopefully this is going to be of help to you. So let's move on and start digging a little bit into the understanding claims history. So, everybody, if you're required to, especially in your bigger accounts, claims history is probably going to be a determining factor in getting the amount of credits you need applied in order to be competitive. So you want to be reviewing the claims history. You want to be looking at what types of losses are there, right? Is there severity and or frequency types of claims? Those are they're going to play a significant role in understanding what you have, what type of risk that you have that you're trying to get a quote for. And then you want to know open versus closed claims. So if you have a lot of open claims, that's going to be harder to deal with than those loss history with closed claims. And then, do you know what the loss ratio is? Is it based on a 3-year or a 5-year? If it's not looking great, it's probably better to base it on 5 years, right? Because you got better odds of showing a lower percentage. But carriers will accept 3. But that's going to be, it's really just, it depends on the claims. So let's take a look. I sanitized a claims report that I just wanted, to have you, take a peek at. And this is actually an insured that I'm going to talk a little bit about. That was a renewal for us that we were able to successfully keep the account. But a couple things to take note of. Your status. Is it open or closed? Well, if you're looking here, this is a really good example of a problem account. Look how many open claims there are. And then you go over here, and they're not in injury date. They're not sorted that way, so you'd have to look down through here. But you can see that there's literally 4 that came in the month of April. This is a current loss history. And so that's a real bad sign when you start to see that. And then you want to look over to the right here, and then you can see that you've got some potential severity claims that are developing here that are going to be a problem, and most of those came in. Well, one of those came in during the month of April, but the other 2 were within the last year, which are not a good sign, and most likely those are all still open. So this was not the incumbent carrier on this was not happy with this account, and I'll talk a little bit more about it. But I'm just trying. And when you're looking at this, the amount of claims, it's not the net expense. It's the total incurred, which will include the reserve and everything. That's the number you are going to, the carrier will be looking at, and that's that $128,250 that is showing at the bottom, the total amount. And that, it's not a great loss history for this particular account. So let's keep going, and then I'll talk a little bit further about it. I'm going to use this insured as an example. So in this particular case of this company, it actually was a property management company that had a number of maintenance people that worked at the properties that they insured. And one of the things is because of this sort of the environment we're in right now, they were having the broker was having trouble reaching the insured, and so we needed a supplemental for to even get the renewal quote released. And we're a week away from the renewal, and we've taken this out to other markets and have not received any other competitive quotes. So finally, the incumbent carrier releases a renewal quote, and the premium has gone from $130,000 to $269,000. They have pulled a more current loss run, because the one we had originally didn't have all the losses on it, and didn't have all those April losses. It wasn't, but it was still considered current up 90 days worth. So and so he just said, we don't feel comfortable with this at all. Why are they having all these losses? Well, that's a really good question. So, but I thought it was a little severe to double the premium like he did. We did get the property supplemental, property management supplemental completed. That did not change his mood on the risk, and so we luckily got one other carrier to come in, and they came in matching the incumbent's premium, that their current premium. And so we went back to them with the loss history, And we did one thing. We asked the broker to go back to the insured and discuss their knowledge of the claims. And in this case, they had just hired a supervisor and sent over a resume where we were able to tell a great story, an underwriting storyline for the carrier as to what steps that they were taking to make sure that they stopped these claims. And I knew immediately when I saw the claims that there was no supervision. That's my experience in the industry. That's usually the case with this type of insured. And so they had already taken the steps that we were able to tell a great story and go back and disclose all of the claims to the carrier, but tell a story at the same time. And they did increase the premium by $20,000, which brought it up to $150,000. But it was so much less that the insured, it was a perfect opportunity for the insured to say yes to the new quote coming from the new carrier. So that's a great example of how you really have to take a look. You have to be on your feet. You have to and be able to, create a story, find out what loss control steps the insured is taking. And if not, bring it to their attention so that they can take those steps. Because ultimately, in the case of this particular insurer, they ended up paying for the year $20,000 more in premium, right? And that's probably going to happen. If things clean up, the premium may come down, but it may take a couple of years for it to come down. And then what happens later, I'm going to talk about, is you will see those the X-bond increase in the futures, which is sort of a double whammy. And I think I'm moving right into that now. So let's talk experience modification. And so what are we talking about here? This can be the most confusing thing, especially. There's a lot of great information, on the WCIRB website, and I'm going to encourage you to go there. But I'm going to try and simplify it for you because it does get really, really confusing. So the X-mod is meant to represent a business's claim history and safety record as compared to other businesses in the same industry within the same state. So so now we go to the bullet point below. So the equation is the X-mod, as a lot of people refer to it, equals actual losses of the insured incurred over a 3-year period of time. And then you're going to divide that by the expected losses for their industry. So same industry. Let's just say you're a clothing manufacturer. Well, they actually, the bureau, they track all of that, so they know what the anticipated losses should be, the average in your industry, and they're going to measure that up by the actual losses. And that's really how the X-mod is determined. It's nothing more complicated. There's a lot more complication to how they address the claims type, small versus large, and there's a big formula to it. And I'm not going to waste our time with that because you're not going to be able to explain that to the insured very well. But you do need to understand that they're being measured. That mod factor is going to be determined by their actual versus what their industry is doing. And that can be a positive or a negative, right? Because that mod rate will ultimately, let's just say the base rate 1.00 is break even, right? You're not winning and you're not losing, so you would not have any debit or credit applied to your premium, but it can have a potential impact if you're having a lot of claims. Then you can really you will have a debit which will go above that 1.00 base mark, and then that percentage is what you're, let's just say you ended up at a 1.20 that would mean that you would have a 20% increase in your premium based on that mod factor. So just giving you some ideas. And please, if you have any questions, please put them into the chat and make sure that I answer anything as we go along, because there definitely could be some questions on this. I'm trying to keep it simple so it doesn't get too complicated. The other thing you need to know about the X mod is that what you're looking at is a unit statistical report, and it's designed to calculate a company's experience modification. Let's just say we have a new business. It won't be assigned a mod rate until it's been established for a minimum of 3 years, and it has to have generated sufficient premium for each of those years. And generally, what I'm seeing, at least in California, it's slightly under around $9,000 in premium where you start to qualify. They've been lowering that down. It used to be higher, and so I have to go on and check to see what that number is. I think it was like 8,900, something like that number. So, and then you have to have that for 3 years. So. The other thing you really want to know is the claims. The claims activity is evaluated over a 3-year period, and the X-mod loss ratio will adjust accordingly at the 4th year moving forward. So it's like a rolling, it's a rolling impact that starts to impact the X-mod ratio after the fact. So that's why I was just using that other one as an example, is that you're rolling 3 years. So let's just say we have, you're already qualified for an X-mod. We're in the year 2020, and you start to have a series of claims that are significant, that are severity. And those will not start to hit until the next year, and then they will roll for 3 years. So you basically the insured will be impacted for 3 years, probably peaking at the height in the 2nd year, and then starting to come down in that 3rd year, and it should fall off in that 4th year. And the credit, you will see more of a credit or a break even depending on where they are in their X-mod. So that's just an important thing to remember, because it's going to hit them later, not right away. The premium is usually what gets them right away. And then the X-mod comes in and kicks them one more time, unfortunately. So there's a lot of incentive to make sure that your insureds are not understand the depth and the problems, the cost involved with with having a lot of claims. A lot of insureds don't understand that, the impact of it, and a lot of times they don't even know, that they're not really understanding that a claim is hemorrhaged. So management of these claims is really important as well. So let's keep going. So this is one thing you guys have probably seen. It's a sample of the experience rating form, and it's published each year for each insured that qualifies for an X-mod. And so a couple of things. It provides the details about classification codes assigned, the payroll reported for each of the classifications, summaries of the claims, and at the bottom you're going to see the experience modification, and you see down on 19 is the experience modification, 20 is the equation that I talked about earlier, and how they got to the expected losses, and that number gets compared to the anticipated, and you can see that there is a this is not a bad account. I mean, they've got a 76% experience modification, meaning that they're going to have a 24% credit applied to their premium, and that's significant. And they're doing well with their claims. A few other things, beyond that, it would be a good tool to point out, how their claims are. If you could look at the claims and see by class code where they're having the problems, you can dig a little bit deeper on this. But this is an important rating worksheet, and you can get this from the Bureau easily. Okay. So, new business quotes, larger account considerations. So we just talked a bit about this. You do need to know the experience modification factor. So that's going to be an important. And if it's not great, there are some carriers that won't quote. They'll quote up to maybe 170%, and then they won't go over that. And then you end up in a really hard to place situation if the claims the mod factor is higher than that. And then again, you better go in with a good story. Assess the need for a loss control program. A lot of the carriers have great loss control programs that they will offer on larger accounts, and so you want to sell that concept and talk to your insured about the need for loss control and what could go wrong if they're not watching out for those claims, those injuries. And then you want to make sure that they have an IIPP plan in place. That's the illness and injury prevention plan. That's a big part of publishing and making sure that loss control program is in place. And then what about a claims management program? Remember, I mentioned that those claims have to be managed. Sometimes they hemorrhage and the insured thinks that it's closed, or and it's not. And so it's important to have on bigger accounts. A lot of the carriers will offer a claims management program where they will participate in helping with making sure that claims are being managed. So these are things to consider on a larger account. Okay. But one of the last things I want to talk about is COVID-19. I mentioned it at the beginning. And so everything is moving. We've been in this strange world, who thought we'd all be part of a pandemic in our lifetime? So carriers, and I'm in the state of California, but we write in multiple states. So you have to take a look at what in your state, what is being mandated by the Department of Insurance. And in California, they sort of mandated that April and May, they would do some kind of relief for billing, cancellation notices, and late pay notices. So they've sort of frozen that. All the carriers have gone along with it. Everyone is, May 31st is supposed to be the end of that. So right now, I want you guys to know that those options are available in California and probably in other states as well. But it's important that you ask some questions of your insureds. Don't rush to just, like with workers' comp, just sort of, take all the payroll down to $1. You need to know whether they have some employees working, right? Is there payroll? And then we need to know what that payroll is. No one should be canceling their policy unless they've gone out of business and have no intention of going back into business, right? So it's important. But here's my thought to you. I'm going to say this. And then last, consider a payroll reduction for businesses that have reduced their employee count, because there are some that have furloughed a few people or some people, and they still have it. So you would just get an estimate of that new payroll and get a reduction done. But I'm here to tell you all as brokers that I'm thinking forward, because I know that if everything is frozen, that means no one's paying any bills, right? Which means I'm not going to receive any commissions, and you're not going to receive any commissions. So we have a stagnant period of time that, I'm hoping as a business owner that they're going to that it's going to only be like in June we're going to start to see this, things open up. And when this window closes, how you all of us need to be, because we will be following up with you. Every account that we reduced the payroll on, we will be revisiting, because we must get the payroll back on the policies in order for you and my company to receive commissions. It's not going to be on all insureds. We have a big book that is not affected to any great detail, but there's a certain percentage for all of us that is being affected. So just remember, as long as you've reduced the payroll to $1 or a partial, you will not receive as much commission or commission at all. And so we need to close that gap, and you need to be thinking forward, because what happens when they give the next round of openings? And are you going to be revisiting to get the payroll back added on? That's going to be important. So I encourage you to think about that and be keeping track of those accounts that you have made those changes on, so that you could get them back in business with their payroll on their workers' comp policy. Okay? Last but not least, I just wanted you guys to see the list of target workers' comp classes. We write a lot. This is just a wide variety of what we write. I believe that Jacob will be sending this out to you in an email, so you could keep this at your desk or keep an electronic version of it, and it's available to check. But if it's not, if you don't see what classification you're looking for, please email Lexi, and she'll address that right away with you and let you know whether we can write that, we can quote workers' comp for you. But it's a lot of classes of business. Okay, I just want to say thanks for joining us. We've got upcoming webinars, and so you can visit our website to see. We have recorded webinars so that you can always be able to go watch. This one will be posted there as well. You can go back and there's so many of them you can watch, and in your free time. Not that we all have a lot of free time, but education is super important. That's how we always get better at what we do. So contact Lexi if you have any questions about any type of risk. We look forward to doing business with you. If you've not signed up and you can start submitting today. And those of you that do business with us, thank you for your business, and look forward to doing more with you. Okay, thanks for joining us. Bye.